Yeah, I think that's right. I see prices are moving up a little bit as the storm comes in, because any storm like this is quite concerning. It creates some risk that volume will be taken off long term. I think the fact, though, that it only moved a little bit indicates that the probability of long-term outages from this hurricane is relatively low. So a little bit of choppiness in the water as a result of the hurricane, but fundamentally the market's pretty oversupplied right now.
Walk me through the structure of the market right now. We're seeing WTI below 70 USD. This is the lowest level since December of 2021. It really seems like oil has failed to catch a bid over the last few sessions, over the last few weeks. I'm wondering, what is the structure of the market right now, and why have we seen these declines?
Yeah, the structure of the market, Dan, really is that over the months and quarters, we've got an oversupplied market. All right, we've got really more crude, or enough crude that we need in the markets today. Third quarter, we saw the inventories come down a little bit. Third quarter is the highest demand quarter of the year. But as we look forward, what we see is that we've got plenty of crude really to meet the demand requirements, and that's really before we add additional barrels in the market from the OPEC Plus agreement to bring back some of that production. So, what we really saw was some downward sentiment and pressure in the market. Several weeks ago when we were at an $80 crude price level, and then we saw this return, or the positive news coming out of Libya, if you go back a week, 10 days ago, and that was enough to really kind of break the tide and drop prices down into the the 70s that we see today, and really that's really where we see prices now for a bit going forward until there's some other significant news in the market that changes that.
You mentioned OPEC, you mentioned Libya. I think one of the other bear cases for the market has been the Chinese demand outlook as well. The data appears to be deteriorating. It hasn't necessarily been as positive as some analysts would have expected. And now Goldman Sachs is even talking about slowing demand growth for Chinese oil into the future. So what do you think that looks like, and to what extent is this also impacting prices?
Yeah, definitely seeing slower oil demand growth in China. There's some longer-term factors there that are behind that. They're selling a lot of electric vehicles. There's some demographic challenges, but I think more in today's market, right? It's the headwinds around consumer spending and around just the concerns around investment and the overcapacity that they've got there in the retail, or in the property sector, and in a lot of manufacturing sectors, right? And you're seeing the Chinese central government taking some steps to stimulate that economy, but not large steps, right? And so really we see weaker oil demand growth out of China, and that's part of why we have this relatively loose market today. We've got a lot of non-OPEC supply coming on. We've got some new projects in Canada coming on. You've got growth out of the United States, Guyana, some Brazil projects. If you add all that up, the non-OPEC supply growth this year largely meets all the demand growth that we need, and so that's why the structure of the market is really looking at OPEC, OPEC Plus, and trying to assess their ability to bring back those volumes that they've committed to do, and what price goes with those volumes, right? How will the OPEC Plus members balance price versus volume, right? Is the key question in the market.